bar, so we'll get right into it. I'm here with Ken Beyer, the best Ken in supply chain. If anybody's paying attention, I've been accused of being the second best Pickett, but that guy said that's lucky I didn't make a way in for the bout. I don't think it's any secret that we're in a down market. We've talked about that. Ken, what is Nolan and Transportation Insight? What is the playbook that we should be doing in a down market, other than the obvious, let's watch our expenses?
Well, I think if you're here to get advice on what to do in a down market, it's probably too late already, right? So,
I missed that.
Yeah, maybe I'll just step back for a second. At Transportation Insight and Nolan Transportation Group, we have two great complementary businesses. One is a brokerage, and the other is a managed trans business. And so if you look at a down cycle, I think it's important to have businesses that are complementary. And our managed trans business is actually up 30% in profitability this year over last year. So it's a good offset to the more cyclical brokerage business. So I think number one, our playbook is to have a balanced set of business across multiple modes and multiple types of business. Secondly, I grew up in a small town in Kansas, so I like farming analogies, so I hope you'll stick with me a little bit.
All right.
But I like to follow the law of the harvest. What you reap is what you sow. So I think in the winter, it's time to work on your equipment, invest in your people, invest in the soil, and get ready for when the sun shines so you can make hay in the sun. So we've been investing. We started a technology investment in 2021. We completed that in 23. So we're ready to roll. We've increased productivity of our staff. We've invested in hiring. So in January, we hired 130 sales reps. We're hiring another 50 in June. So we're continuing to invest in the down cycle so when the market does turn, and if it's next week or a year from now, we're going to be ready to take advantage of the market when it comes back.
Yeah, so I think that's a great answer. Talk about this down cycle, though, compared to, you've had a very long career in logistics, and we're doing e-commerce fulfillment before anybody knew what that actually meant. Talk about this cycle versus previous ones you've experienced, and is it really the worst ever? What's different about this one, and how does it compare to previous periods of softness in rates and volume?
Yeah. I started a logistics company in 2008, right before the Great Recession, Great Financial Recession. So
that was another tough one.
That was tough, and particularly because it was my own money and I was making payroll on credit cards. So this is a little bit different for me personally. But I will tell you, in the span of my career in logistics, this one feels different. And I think it's because we're coming off such a high, and we've heard a lot about it in the last few sessions and all day today. But I think what makes it feel different is how high it was, and all of us kind of getting this idea that this is the new normal. We're convincing ourselves it's the new normal. When in reality, if you look at history, we go through cycles like this, and at the peak is when we all should be thinking about reducing costs, not when we get to the bottom. And I think for many of us, we misjudged when we were at the peak and continue to invest while we're coming down into the bottom of the cycle.
Yeah, and I think that's an important thing to recognize, that the good times don't last forever, right? And so now we're kind of in this breath-holding contest to see who can come out of the other side and catch the upswing. You talked about the investments you guys are making now, and you're starting to prepare for the upswing. What are the other things that in the good market, you talked about making technology and getting efficient, you talked about cutting expenses. Is there anything you wish that you guys had done in the, call it mid-2000 to early 23 period, and anything you saw others do and said, I wish I'd done that?
I think in the 2020, 21, there was a lot of hype around tech, and there was a lot of pressure on us to move faster with our tech investments and be a little bit more on the bleeding edge. We made a very disciplined decision to say, well, we're going to spend a lot of money, and we spent $100 million on tech, so it was not a small investment.
Wow.
We are not going to be on the bleeding edge, and we're not going to go hire 800 engineers in-house because this is a specific period of time that will end. So I think we were smart in the fact that most of the tech build that we did, we brought in our own product people to design the product, but we didn't hire a bunch of engineers. We kept that mostly outsourced. So when the project was over, the day after it was over, we let 500 contractors go and reduce that expense very quickly. If I look back on what I wish we would have done, I think that in terms of the tech investment we made, I think while we broadly, focused on the internal processes of our company, we call it our operating system, I wish we'd have spent more time on the external interfaces with customers and carriers. And I think if, a lot of us now look back on where efficiency is really gained, and you can gain a lot of efficiency internally, but the real efficiency is in the interactions between your trading partners. And so I think we could have spent more time in that category in terms of the tech investment.
Yeah, and building that relationship, because when the shipper has the upper hand, the carrier and the broker sure value relationships suddenly, don't they?
No, I mean, and that's been a big hallmark of our business is we don't believe in a tech-only or a people-only solution. We believe in what we call a hybrid digital solution is people are the relationship, right, and the machine is there to help the people be better.
Yeah.
And so that's always been our mantra is focus on making people better, not replace them.
Sure. So you mentioned that you guys are investing for the next upswing. That must mean that you have a view on when that's coming. You're hiring people. What does onboarding look like? Is it 3 months, 6 months, 9 months? And is that you showing your hand about what your opinion on when we might see some recovery in rates?
No, I think we have a very specific data point that we look at in terms of when we're going to invest. When rates, and we're an 80% spot player in our brokerage business, when spot rates year over year go inflationary, we invest. And in January, rates went inflationary. Most of you know.
Yeah.
It went inflationary for a little bit. They came back down. We invested. It's a binary decision for us because if you look back in history, every time rates go inflationary, there's usually an upcycle that follows. And it's not immediate. It's going to be 2 quarters before in fact, when the upcycle starts, it's really the worst time for a brokerage in many ways because you're getting squeezed. And from a cash flow perspective, you're collecting at a lower rate and you're paying out at a higher rate.
Sure.
So you're eating a lot of cash in the upcycle. So for us, you need to invest soon before you start eating up all the cash in the upcycle. And you need to get your teams trained up and ready to go. So when you get to the peak, you're harvesting when the sun shines. So we look at it as a 6-month investment. And that's why we're hiring at least 6 months ahead when we think the peak's coming.
Right on. You talked a little bit about this being a really cyclical industry, and in the the great debate, we heard a little bit about, is the cycle getting more volatile, less volatile? Do you think that we're going to see more frequent cycles, less frequent cycles, or COVID made this one a little weird and we'll go back to the norm? And then in addition to the business mix, is there anything else that you think from a structural, multi-cycle perspective on structuring business that you would do?
Well, I think, again, when we talk about cycles, we're talking primarily about brokerage.
Right.
And I think the benefit that we have is that we're looking across multiple cycles. We have a $10 billion parcel business. $10 billion of parcel contracts running through our systems. That is a completely different cycle in many ways than the traditional freight cycle.
Diversification.
Right. We have, 20% of our business is drayage. We have a managed trans business, which is a 3 to 5 year contract business. So you lay all these cycles together and over each other, and what we're striving for is a more diversified cycle that we're not just riding the ups and the downs constantly. We've got a base business that's growing year after year after year in our managed trans, in our parcel business.
Yeah.
And that allows us to invest in this more cyclical business, which is brokerage. The downs aren't nearly as low. The highs can be even higher because we can keep investing in the down cycle of the brokerage market while others are cutting. And then when the cycle comes back, they're not quite as ready. We're still investing because we have these stable.
Yeah, the stable business to put cash flow back.
So I guess to answer your question, just like everyone else, we want to know when the cycle's coming back.
Yeah.
But I think we're less subject to that based on the business model that we have.
Very good. So you guys are building the sharp ratio, efficient portfolio of transportation businesses. I guess talk about, so you said it's a 6-month cycle. You started hiring in January. Might have been a little early on that one.
Yeah, we were early.
But you're hiring again, so that says to me that you think, okay, maybe it just moved out 6 months. And so is it fourth quarter this year? Is it first quarter next year? When do you guys think these investments are going to pay off?
So, we think the freight business is complicated and trying to figure out looking at all the data. This debate was great, looking at all the data. I was talking to my brother the other night about what he's going through. He's a Kansas farmer, right? He was telling me, he makes $200 an acre on crops. But before he plants his first seed, he has to put $70 of herbicide on the ground to make sure there's no weeds that come up. Because if he cuts costs, he doesn't think it's going to be a good harvest season next year, and he doesn't put any herbicide down, it cuts his productivity in the next harvest by 15%. But not just that, for the next 5 years, he's got less productivity out of his land than every other farmer in the area. I was like, man, that sounds a lot like brokerage. If we don't invest constantly in the herbicide, keeping down the weeds or the stuff that cuts productivity, we're going to be paying for it for 5 years. And we saw it in many ways. Many of you can relate, is during 2020, we were just doing whatever it took to get loads in the door because you're making so much money per load. We weren't investing as much in our people. We weren't training them as well. And I think we have seen since then the quality of the people we brought in during that period probably didn't go through the tough times we're going through now. Didn't get the right training, didn't have to fight the battle as hard. It was really easy to throw your fishing line and get a fish on without really much work. So I think we're seeing a similar thing play out in this industry is you've got to constantly be planting seeds, investing in your people, bringing in salespeople and training them, especially in a down market, because that's when they really learn what it's like to be a great freight broker and take care of your customers.
Yeah, and I love that I love the weed and crops analogy and putting down the Roundup. So, I mean, is that what you guys do internally? Is it a 5-year plan? Is that what everybody out here in brokerage should be thinking about? Is I need to have a plan for the next 5 years, and I mean, do you war game out? It goes up, goes down. What is the long-term planning process look like for you guys?
Well, I think you have to have a long-term horizon. We're building a great company for the long term. I think it's why it's particularly tough to have a company in our industry be public, because you're constantly hitting the quarterly numbers.
Yeah.
But a business like this takes a long-term, it requires a long-term vision because of the cycles. So as I mentioned, our strategy is that this market is huge. The biggest player has, let's call it 4 to 6% market share. There's plenty of business to be gotten. And while I don't believe there's going to be a consolidation that everyone's talking about, there are going to be big winners, and there's going to be a very long tail. Take any other industry that's similar, banking, insurance. What you have is 4 to 5 big players on the back end. You still have lots of independent financial analysts that talk to you, brokers, if you will, but they're all repping one of the big players on the back end. I think over time that's what happens in our industry, and we aim to be one of those, let's call it 5 big players, that really all of the business is somehow being touched and orchestrated through.
So if brokerage is going to do that, like you said, and I agree with your opinion there, do you think we're going to continue to see more of the market share of the drivers shift to the smaller end and the owner-operator, as we have? Growth of brokerage certainly has supported that.
Yeah, brokerage share of the market continues to grow every year. Smaller owner-operators continue to grow, and the reason is because of technology. And technology is going to continue to, in my opinion, going to continue to make that happen. You're going to have more and more diversification at the carrier level. Now, I think when and if autonomous vehicles ever come to play, that could have a different impact on what happens there. But technology's allowed for the business to go the opposite way of consolidation, to fragment even more.
Yeah, so we've heard a number of answers to this question. How are you surprised by how long some of the small carriers have been able to hold on, and what are you seeing in your brokerage business that suggests, how much longer can they hold their breath?
I think brokers have a lot to do with that. I think there's been a lot of brokers that have helped subsidize this market for a while.
But by lowering their margins.
By lowering margins. If you look at the margin stack, if you will, between shipper and carrier, brokers have lowered the margin, paid a bigger share of that to carriers. That's helped keep carriers in business longer. That can't keep lasting, especially brokers that are on asset-backed lines and continue to dig a deeper hole with every load they're taking if they're losing money. So I think there's an end to that merry-go-round coming, if it hasn't already. But I think carriers are very scrappy. They're entrepreneurial. As an owner-operator and someone who's making a living driving a truck, they're very adept at doing whatever it takes to stay in business. And I think it's going to take a while for capacity to come out the way we think. I do think, though, that it's not just the carriers, it's also the increase in the number of brokers that have come in the market that have changed the dynamics.
That made that more competitive, and Yeah, some of that's going to the carrier. Interesting. Well, you mentioned autonomous. Obviously, that has been written about, ad nauseum, but still is coming for us one day. Whether it's autonomous or anything else, you've been in the industry, you've seen a lot of change. What are your long-term, call it 3 and 5 and maybe even 10-year predictions for changes we're going to see, akin to some of the changes we've seen in the past?
I'm sorry, I'll go back to the farming analogy.
Okay, let's do it. Yeah.
So,
That's fine.
family.
Farming's changed a lot in the last.
I was going to say, we
30
think
years.
that farming is like the most backward industry in the world. Do you know that most fields right now are planted completely autonomously?
I have read that.
People are still in the tractors, right? But the satellites are driving where it's planted. They know the pH and acid levels of the soil. They know the moisture content. Farming is so sophisticated today.
There's AI cameras spotting the weeds and shooting lasers at them now.
Exactly.
I was reading this the other day. And
my brother said in his farm, he used to have 5% overspray on herbicide, 10% overseed, whatever. Now it's down to 0.5%. So his productivity has gone through the roof. What about his margins? Haven't changed at all. Same things I think will happen in this industry. Autonomous, AI, all this tech's going to come about. It's just going to drive the price of entry into this business up.
Yeah, and
our
so
margins
that's what drives the consolidation you're talking about, is it?
Right.
Yeah.
Our margins aren't going to get better. We all think we're going to drive productivity down, we're going to make a lot more money. We're not. It's actually going to, our margins will probably go down over time, but the price of entry to enter this space will get higher, and it will drive out the smaller players from being the full spectrum transportation management providers that I see in the future. I think there'll still be a lot of brokers taking care of small and medium-sized businesses almost as agents with a bigger platform in the back end.
Yeah. So, I started my career in financial services. That's absolutely what happened with intermediaries there, is they consolidated and got bigger.